Asset bubble. So here is the outline for today's lecture. We will first have some discussion of asset and asset prices, right? I know some of you have already taken or are taking finance course, so these concepts are probably not that unfamiliar to you. So for those who have taken finance course, here is just a review, right? For those who have not, this is just maybe the first exposure to the important concept in finance, what assets are and how the prices of assets are determined in theory. And then we'll discuss an interesting phenomena, which is the focus of today's lecture, is asset bubble. Right? So we will first have some discussion of past asset bubbles, famous asset bubbles in history, in real asset market, and then we will have a discussion of experimental bubbles, meaning asset bubble observed in laboratory experiment. So here is a slide that have an overview of the key concepts in finance. So one important concept is probably capital, right? So capital in finance is different from the capital in economics. In economics, capital means the machines that you use to produce things, right? But financial capital refers to money and resources used to finance business. When you try to start a business, you need to have the resources to run your business, right? So it's the money and resources that you use to operate, to keep your business operating. So that is capital in finance or financial capital. There are two main forms of financial capital. One is in the form of debt, and the other is in the form of equity. So equity will give you some ownership, right? So if you have the equity of some firms, then you have the ownership of that firm. A stock, for example, is an important form of asset, of equity, right? And security is a special type of financial capital, right? So security refers to tradable financial contracts that represent a claim on financial capital. Right? Is a contract that give you the claim on financial capital. So two important forms of security include stocks, or it's called equity security. It allocate ownership rights of a company, right? So if you own a share of stock of Tesla, for example, or Novo Nordisk, for example, then you have a small fraction of the ownership of the company. And that ownership would give you the right to claim the earnings of the firm in the future. Bonds represent debt security. It's promise payment to lender, right? So bonds basically is representing the debt that the bond issuer owned to the bond holder, right? So when you hold bond that issued by Novo Nordisk, for example, then the company will need to pay corresponding yield, interest for you lending money to this company, right? So that's why it's called debt security. And an important actor in the financial market is financial intermediaries, right? Financial intermediaries include institutes that channel funds from the suppliers of capital to the users of capital. So the suppliers of capital can be the savers, individual savers, the households who save money, or investors who just purchase the stocks. And the users of capital, meaning that the business or also the government who need money, need the resources that they buy this financial capital from the suppliers, right? So financial intermediaries include banks take deposit and provide loans, including mortgage, business loans. An investment bank, they underwrite security, right? So they also help companies to raise capital so that they have the resources to fund, to operate their business. Mutual fund and pension fund, they pool investors' money and invest in a diversified portfolio. Right? So this is just one slide to give you an overview of the key concepts in finance. Now, because we are focusing on asset bubbles, we need to give a formal definition of asset, right? So stocks are actually quite maybe the most important form of asset. So an asset refers to any resource that can be used to produce positive economic value, right? So assets represent the value of ownership that can be converted into cash. Right? A stock is definitely an asset because when you own a share of stock, then the future earnings of the company will be paid to you as dividend. Right? Sometimes these earnings can also be reinvested so that your stock would appreciate in price. So any resource that can be used to produce positive economic value in the future can be understood as an asset. So a share of stock represents fractional ownership of the corporation. Right? So that's the definition of asset and stock. Right? So in that sense, apple trees, for example, if you own an orchard that have many apple trees, so the ownership of that apple trees can also be considered as an asset because the apple trees can produce apples. That's the future yield, future values determine the value of the asset, which are the apple trees. So any resource that can be used to produce positive economic value can be considered as an asset. So now, for the rest of this lecture, we will focus on this specific asset, which is a stock. Right? Talking about stock, we see the stock market that have this trades between the buyers and sellers constantly, and the price fluctuate sometimes dramatically from time to time. So you might be wondering what determines the value of a stock, right? So financial theory would tell us how the value of stocks should be determined or how the price of a stock should be determined. The fundamental value of a stock or the fundamental value of any other asset derive from the expected cash flow from owning it. Right? So suppose you have one apple tree. The fundamental value of that apple tree is just future cash that by selling the apples. Right? So this expected cash flow from the owning that tree would be determine the fundamental value of an apple tree. Right? And for the stock, is the same thing. The fundamental value of a stock derived from the expected cash flows from owning it. So when we talk about cash flows in the future, those cash flows will be discounted because future cash are not valued as highly as the cash you hold now at hand. So when we talk about intertemporal decision making, we'll elaborate on the present value and the discounting. Right? So here you just need to know that future cash should be discounted, right? Because if you put the money, put the cash in the bank, you are able to earn interest, right? So that's why 100 Danish kroner next year will worth less compared to 100 kroner today, right? So that's why future cash flow should be discounted. Earnings and profits are the source of cash flow to the shareholders when you own the stocks. And one important indicator of a stock is the so-called PE ratio. PE ratio here, PE represent price, E represent earnings. Right? PE ratio is the price to earning ratio, which measures the ratio between the price of a stock and its per share earning. So in a sense, in a very simplistic, intuitive way of understanding PE ratio, you can consider it as how expensive the corresponding stock it is. Right? So if PE ratio is high, meaning given the current earning is price is higher than other stocks with lower PE ratio. Right? Roughly speaking, PE ratio can be understood as the number of years to get back your investment if P and E are constant over time, right? Suppose the price of the stock is constant, the earnings of the stock is constant, P over E, this PE ratio representing how many years you invest $100. PE ratio would give you an estimate on how many years the dividend you receive from holding the stock will be equal to 100, right? So That means after this many of years, P/E ratio years, you will get back to your original investment. Earnings of a company have multiple ways of usage, right? So it can be used either as payment of cash dividend to shareholders as cash, right? So that's the cash earning. But it's not necessarily the case. It can also be used as retained earnings to raise future cash flow, right? So meaning that I have earnings as a company, I do not pay this earnings as dividend to the shareholder. I will use this cash for some other alternative usage or alternative goals. Returned earnings can raise the future cash flow through payoff of debt to reduce interest expense, right? So we mentioned that a company can fund their operation by borrowing money as debt and also issuing stocks as equity. Right? So sometimes the earnings of the company can be used to pay off debt so that the future interest expenses will be lower, meaning that can generate a higher cash flow in the future, even though you spend some of the cash flow now to pay off debt. It can also make investment to other assets or acquisition of other firms in the hope that this investment can be more profitable. And then the earnings from this investment will be also the earnings of the company, eventually that raise the future cash flow of the company and also dividend paid to the shareholders. It can also be used as investment in capital to increase future profit or repurchase a firm's own share, or is called buybacks, right? So sometimes the company buy back their own shares, right? Because that would reduce the number of shares circulating in the market. So that means holding the value of the company constant, each share would increase in price, right? Because of the reduced number of shares are circulating, right? Because when you repurchase your own stock, the supply is higher, so that will drive out the price of the stock so that each of the shareholders would benefit from the increased price of their stock hold in their hand. Now, given this multiple usage of cash flows, we can conclude or express the value of a stock mathematically. So suppose we have the following letters to represent different variables. So D represent the dividend per share that you can receive each year. Not each year. It's the dividend per share you can receive next year. And also the dividend would grow at a rate of G. This is the dividend growth rate. And R represent the risk-free return rate, right? It can be considered as the interest paid by bonds. Right? Then, given these three letters, three variables, we can define the value of a stock as the present value of all future dividends. Eventually, the earnings will be paid as dividends, right? So that's the cash flow, right? So suppose D is just the dividend paid next year, then the present value of that dividend this year is D divided by 1 plus R, right? Because if you put this D divided by 1 plus R money as risk return investment, next year it will give you D. So that's why this present value of D will be discounted by 1 plus R, right? And then in the second year, the dividend is D multiplied by the 1 plus G. So G is the growth rate. We are just expecting the dividend is growing in the future. So D multiplied by 1 plus G is the dividend received in the second year. And the present value of that will be discounted by 1 plus R squared. And similarly, we have the dividend received in year 3 discounted by this to get the present value of year 3 dividend. So we sum these things together. That gives you the present value of a stock. Right? So if you remember from your lessons of algebra, so this is just a geometric series. It has a common ratio, so we can calculate this value of this series, right? So that is just D divided by this difference between R minus G, right? So this expression is telling us that the value of a stock is high when the dividend is high. When the dividend increase, the present value is higher. And when the dividend growth rate is high, G is the growth rate. When G is high, then the denominator will be lower, so that would increase the present value. And when the return rate of risk-free asset is low, right? So meaning that when the interest rate increases, that means the return rate of risk-free asset is higher, that would actually decrease the present value of stock. So that's why you would observe that whenever the Federal Reserve in the United States, which is the central bank of the United States, announced the decrease of interest rate, then we are expected to see the stock price to rise. Right? So that can be understood by this formula, right? So that is the definition of asset and how the price of asset should be determined theoretically. Right? And now we will get to observe some asset price in real life. Right? So what would occur in real asset market? And one interesting phenomena that we can observe is the so-called bubbles. Asset market, if you look at the corresponding history of the asset price, often exhibits strong price swings that cannot be fully explained by changes in the underlying economic condition or the fundamental value. Right? So sometimes we observe bubbles. And bubbles, or say asset bubbles, refer to periods when asset prices greatly exceed their intrinsic value. Right? Think about the definition. Asset bubbles refers to the period of time when asset prices greatly exceed their intrinsic value or fundamental value determined by the previous formula that we have just seen. Right? So why is this the case that we constantly observe asset bubbles? So we can recall this Keynes beauty context analogy that we introduced when we study strategic interdependence. Right? Many investors, when they are trying to make investment, they probably focus not on fundamental value, at least not only on fundamental value. Their goal may be just try to predict which stock other investors will find attractive, right? So that's why, if this is true, then we are able to observe this great deviation between the asset price and its fundamental value. Right? And if this is true, if a lot of the investors, without looking at the fundamental value of the asset, but just try to understand and try to predict what other investors will purchase, will find attractive. So this would lead to this so-called great fool theory. Right? The great fool theory is just trying to describing the situation that many traders care less about fundamentals, but more about the price they expect to sell in the future. So investors may knowingly buy overvalued stock, right? So some investors, even though they think the corresponding stocks are overpriced, they still are willing to purchase that stock or that asset because they believe that in the future, some other investors are still willing to purchase from them at an even higher price. These later purchases can be considered as a so-called greater fool, right? So that's why it's called greater fool theory. And even if traders recognize that prices are misaligned with fundamentals, they may believe that they can sell quickly enough before a crash occurs so that they can benefit, reap the gains from this roller coaster of these price swings, right? To gain some profit from this bubble. However, I mean, most people who believe this greater fool theory would make this plan. But if you check the evolution of bubbles, when a crash does happen, it's very difficult to withdraw without suffering any loss. Because when price crash, everyone want to sell. And you know that in the market, when there are all sellers and without any buyers, the price will approach zero. Right? So when there are no buyers at any price level, I mean, the price will just go down to zero. And that causes a very immediate crash of the bubbles so that investors believing in this greater fool theory can easily suffer some significant loss. So that's one theory why bubbles could occur. Right? So now let's just take a look at some of the history, right? To look at some of the historical bubbles, famous bubbles. Maybe we could learn from them. So the first known asset bubbles in history is tulip mania in the Netherlands. Right? So you know tulip is the beautiful flower that are very popular in the Netherlands. So this tulip mania occurs in the 1600s. So here you see this evolution of the price of one single tulip. Right? So in February 1637, some single tulip bulbs sold for more than 10 times the annual income of a skilled artisan, meaning that if you are high class skilled artisan, you can, I mean, your salary level is high. But in order to purchase one tulip bulb so that you can plant and this flower later, you have to spend your 10 years earnings. Right? So it seems unreasonable, right? And indeed, this price did not last that long. I mean, there was a rumor that this crash was first in a sailor who mistook the valuable tulip bulb of a merchant and considered it as an onion and cook it and eat it. And then the merchant realized that sued this sailor uh, to the court, and the sailor have to, spend the rest of the time to spend all his earnings in order to pay back the tulip. And then people start to realize that it's unreasonable, right? So this is just an anecdotal story. Whether it's true or not, we don't know. But we can sense this craze of tulip, of this bubble, right? So that's the tulip mania, the first known bubbles in history. And the second famous one occurs in the United Kingdom in the 1700s. Right? It's the South Sea Company, and the corresponding bubble is therefore called South Sea Bubble. Right? And we can see this evolution of the stock price of the South Sea Company. I mean, this company have some monopoly over slave trade back then, but it never monetized those monopoly. But people just keep believing this story, right? So it does not earn any profit, but people believe that it will earn profit, has a great future. That's why people just buy. And as the price of this company stock increases, more people pouring in to purchase this stock, right? So here is just the evolution of the stock, right? So Newton, Isaac Newton, famous physicist, scientist, actually even invest in this South Sea stock and earned some money, right? So here is the first investment by Newton. You see that is probably at a reasonable price, right? And then after earning some money, I mean, after the investment in value, Newton exit very happy. But then the surge of the price of South Sea stock did not stop there. Newton started to realize that all his friends who made the investment keep earning money since it seems so crazy. And most people, when you observe that your friends you invest in some stock and earn a huge amount of money, I mean, you will have this mixed feelings, right? So it's very likely that you will be motivated to purchase the stock. This is a so-called fear of missing out, right? So you could start to think, what could have been if I have invested this in the stock so that I'll be wealthy, right? And then Newton could not resist the temptation, so he invested more so that he can earn similar considerable profit as his friends. But you see that the investment here is already too high, right? And without before long, the crash of the stock price was observed. Newton, when it crashed like here and then it rise, most people would think, oh, it finally stop in reduction of price, it will appreciate too soon. But it did appreciate, so that the crash sometime will have some rebound, but it's a very short period, short-lived rebound. Eventually, it was crash. So initially, Newton was reluctant to sell the stock, but after the crash, Newton just sold all his stock in 3 times, right? And lost huge amount of wealth. Right? It's actually, you might have heard a famous quote by Newton. He said that I can calculate the motions of heavenly bodies, but not the madness of people. Right? So this is right after Newton's loss from this investment in the South Sea Company. He actually lost 20,000 British pounds. Right? So this is equivalent to 4.4 million British pounds in 2020. Oh, that's almost all his wealth. Right? So that's why he was to retire, but eventually he was hired again by the government to supervise of the currency of the United Kingdom. But that's another story. So you see that great physicists know how to calculate the motions of heavenly body. I mean, it's still difficult for them to understand human madness because social science is very different from physics, right? So physics, you are studying objective particles that follow a certain law. But human beings, I mean, we still have some laws to follow. We have certain heuristics to use, certain biases that we experience. But because people constantly reacting to other people's action, this so-called strategic interdependence is very difficult to predict the aggregate market movement. So that's 2 famous bubbles in history, right? So here is actually a conceptual model of speculative bubbles, right? So at the first stage is smart money, right? So it's just invest according to the fundamental value. So here we assume the fundamental value of this asset, of this stock, is represented by the dashed line, right? So at first we have this smart money, they invest like Warren Buffett would do, purchase this when the price is lower than the fundamental value, so that in the future it can increase in price. And so these are the first movers. They will earn a huge amount of money. And then we have institutional investors who get in. This would drive up the price. And then once the public realize that this is a good stock, I mean, it may attract them to pour in. And then it's keep rising. We have the medium attention. Then we have the public enthusiasm. I mean, people start to fear of missing out. They have this greed. They have this delusion, and then they see that it reached the peak. They would believe that this time is different from all the previous bubbles. It will keep increasing, but then I mean, it will eventually, because it cannot be sustained by the fundamental value, it would crash. Right. So here is a point. Maybe when the shoe shine boy suggests favorite stock to you, it means that most of the public already invest their money in this particular stock, meaning that there's probably no room for further rise in the stock. That's probably when the price already reached the peak, and the future is likely to be a crash. Right? So this shoe shine boy story was actually involving the father of John F. Kennedy, who was the president of the United States. So Joseph Kennedy, the father of JFK, made a huge amount of money in this 1929 Great Depression, this stock market crash. Right? So because, I mean, the anecdote, the corresponding story is that one day he just went out and to have his shoes polished by this shoe shine boy. And then by this casual chatting, this boy was actually start to suggest some of his favorite picks of stocks. That made Kennedy realizing that it's probably the time that everyone has already put this money in this stock, and it's likely to crash in the future. Right? So that's why I put this when Shoeshine Boy suggests favorite stock. Right? So when the barbers, for example, when the janitors start, who has no training in investment, very little experience in investing start to talk about and give you advice in investment, is probably the time that you will observe crash in the near future. So I receive a message, where do you think the AI bubble is at right now? Well, it's quite a good question, but I can tell you there's one drawback of looking at real asset market is that it's very difficult to know, at least not in advance, whether a bubble indeed occurs. Whether it's a bubble or not is quite difficult to say, at least in beforehand, right? So I'm not the one who will make any judge. Of course, here is just an academic course on behavioral economics. I will not make any investment suggestions, right? So you can make your own judgment. Maybe you can tell me, then we can have some elaborate discussion on that, right? So that's the two famous bubbles back in history. Now let's look at some novelty examples. Right? So here, let's first look at these stock prices of S&P Standard Poor 500, representing an index of 500 biggest public traded companies in the United States. Right? So the solid line represents the real stock price. Real meaning that it has been adjusted for inflation factors. And this latter, this gray curve representing the corresponding earnings. Right? So we see some quite famous stock market crash, right? In 1929, that's right before the Great Depression. That's one crash. And the famous dot-com bubble crash in early 2000, that's another one. I mean, that's actually the craziest crash because it's reached almost the top of this index level, the stock price, right? So it's even higher than 20 years later, right? So we surpassed that top price during COVID time, after COVID time. And then this crash during this great recession, this 2007 and 2008 financial crisis. Right? So here, an interesting observation is that when we observe these large price earning gaps, for example, here, if you look at the stock price and the corresponding earnings, of course, earnings is just an estimate, right? So it cannot fully incorporate future earnings. It's just based on the current year earnings. But we do observe the current year earning is probably a good measure because whenever we observe this large price and earnings gap, we will later observe some sharp market corrections. But when the correction occurs, we don't know. Right? So it's difficult to say to prescribe and specify an exact. So timing is very difficult in predicting when a crash would occur, even if you believe a bubble exists. Right? And then we see the second one, this early 2000 dot-com bubbles, right? They significantly deviate from these earnings. And in this 2007, we do observe this rise in earnings, but it's still a bit high, right? So usually, based on past history, whenever there's a large price earning gaps, it's likely that a later market correction, sharp market correction would occur. So now let's just take two of these bubbles. The first is a dot-com bubble, and then we look at the financial crisis in 2008 and to learn something from it. So here is the dot-com bubbles, right? So from 90s, we have the corresponding stock price for NASDAQ, right? So dot-com bubble mostly occur in NASDAQ, these high-tech companies. So in S&P 500, it occurs, but not as dramatic as NASDAQ, right? So if you look at the evolution of the prices, you'll see that between 1995 and March 2000, investment in NASDAQ Composite Stock Market Index rose 800%. Well, but it fell to 78% from its peak by October 2002. Right? So within a year, it fell 78%, more than close to 80%. Right? So this is definitely, I mean, looking back is a good example of bubble, right? Great deviation from fundamental value. But when you are in the bubble, you might not realize. A lot of people during the bubble just think that now the earnings cannot represent anything. You have to look at the potentials of the companies to determine the real value of the companies. But it seems that this wisdom is not wisdom, right? So a lot of time when people say that this time is different, but this turns out to be exactly the same. It just replicate the history. One interesting observation of this dot-com bubble is the corresponding confidence of the stock market from a survey conducted by Yale University. So this survey asked the corresponding investors how confident you are that the price is right, it's not significantly overvalued, right? So if you look at the corresponding survey, right? So you see here we have institutional confidence level and individual confidence level. We do see that before the crash, most people think, like 70% of people think that the stocks are actually overpriced, overvalued. So this is probably of this greater fool theory. People perhaps buy at increasing price because they believe the price will rise further, right? So it's a good illustration. Right? So it helps us to understand the corresponding mechanism. And now the second example and the last example we will cover is this financial crisis in 2007, 2008, right? So this causing by the housing bubble. So here is the graph that I get from the book Irrational Exuberance by this Nobel laureate Bob Shiller, who's a professor at Yale University, which is actually part of the team that conducted the survey on the confidence level. And you see here, these figures represent the population growth, interest rates, and the building cost, right? So you would expect prices, the values of house should be related to the fundamental value, which is related to population. I mean, the more people there are, of course, the demand will be higher, the value will be higher. Building cost is, of course, one important factor. The higher building cost, meaning that the housing price will be an interest rate, of course. So these three are the three important factors that would influence housing prices. But as you can see here, just in early before the crash of the stock market, before the financial crisis in 2007, 2008, I mean, it's actually significantly deviate from these fundamental factors, right? I mean, the major bubble is actually the bubble. And the housing bubble alone is not a big issue. It will not cause financial crisis and this great recession in economy. It only caused this HOVAC, this financial derivatives based on the housing price, right? So it's actually you can consider it as putting a leverage on the housing price. When it crash, it actually will cause the whole economy to collapse. And here you see this crash is represented by the S&P 500 from the end of 2007 to 2008. We see a dramatic decrease. So we call it a global financial crisis because it's not only occurs in the United States, right? Even though it's originated from the state, but all the other countries have to pay the cost, right? So across, we see dramatic decreases in the corresponding stock value. So these are the change in market index percentage decline across countries for 2008. Okay, so that's the discussion of bubbles in real market. We'll take 10 minutes a break, and then we get back to discuss the limitation of looking at real market asset bubbles. As I just mentioned to Alexander, the main issue of looking at the bubble is that it's very difficult for us to know ahead of time whether a bubble occurs because we never know. We can have an estimate, but we could never know for sure the fundamental value, right? So that's one limitation. I mean, that's actually one reason we want to have experiment in the lab, because in the lab we can clearly calculate the fundamental value, and then we can observe whether with clear fundamental value, asset bubble can still occur. So one last thing I want to discuss about real world stock market or asset market is that sometimes we could observe unexpected price swings, right? You might think it looked like a crash, but it's probably not a bubble behind the crash, right? So here is just one example, a famous example that occurs in 1987. So in October 1987, stock market crashed. This was unlikely to be caused by a bubble because the market quickly rebounded by the end of this year, right? So this is a good example because there's no obvious reason behind the crash. Different academics, different investors had different explanations, different theories behind this. So there's no consensus or agreement what caused this crash, right? But it's a good illustrative example that demonstrates sharp price swings from speculation are often indistinguishable from those driven by fundamental value or random shocks, right? So here, it may be just due to random shock. So because this unexpected price swing make it quite difficult to start to study bubbles in real market. On the other hand, as I have already emphasized, asset bubbles are really difficult to identify, at least beforehand or while you are in the bubble, right? This is because fundamentals are uncertain and constantly changing, right? So talking about the AI, what are the real potentials of AI, right? The large language model could significantly improve the productivity, but we have not seen this great improvement, but it's not eliminating the possibility, right? And because of this optimistic expectation about the future, people, a lot of money is pouring into this AI industry, and correspondingly, chips also increase in price. The stock price of those chip companies also appreciate, right? So whether it's a bubble or not, it's difficult to say, right? While we are in this period, it's quite difficult to know whether it's a bubble or not. This sometimes we observe this price change, price swings. It's difficult to understand or explain whether these price changes are driven by speculation or by shifts in expected return. Right? You may claim that the crash is just by sudden shift in expected return. It's unlikely, but you cannot completely eliminate the possibility, right? So all these factors make it quite difficult to study bubbles in real market. Because of this, it's actually quite helpful for us to take a look at of the experimental asset market. You ask people to get into the lab and simulate the market where the fundamental values are known to everyone, right? And then we decide and we observe whether bubbles can still occur, right? So this type of market in the lab can help us understand the underlying mechanism behind bubbles, right? So here, fundamental values can be easily calculated, and the fundamental values can also serve as a benchmark from which price bubbles can be measured. We can know for sure whether price bubbles occur and when exactly the bubble occur and when exactly it crashes. And then we can understand everything in between to understand the corresponding mechanisms. So this type of market demonstrate how investor behavior, expectations, and coordination can generate price deviation from fundamental value. So I already reviewed the result. Basically, even we know the fundamental value for sure deterministically, right? Precisely, asset bubble can still occur, right? And then the market in the lab could help us to understand the corresponding mechanisms, what is going on, what are the factors that make it more likely to occur, right? Give us important insight. So here is the interface that you saw for the last experiment you participated is asset market experiment, right? So basically you own a certain amount of cash, you own a certain amount of shares of asset. The asset could pay you a certain dividend each period, and then you can decide to trade the asset. You can either buy or sell. Right? So basically, you just put the price there, the minimum acceptable price to sell as a seller, and the maximum willingness to buy as a buyer, and then you can just purchase shares from others or sell your shares to other people. So here, the general setting of experimental asset market is that assets are traded over fixed number of periods, right? So in our experiment, the market opened for 10 periods, even though we did not have time to finish the whole 10 periods. So we only finished half. We only finished 5 periods. But as we can see later, we already observe obvious bubbles in almost all the markets that involves the participant, right? And in this asset market, as mentioned, the assets are traded for a fixed number of periods, and the asset will pay dividend at the end of each period with known probability, with some kind of distribution. And because of this, fundamental values can be calculated precisely. Right? So here is the settings of the first original market experiment that demonstrate asset bubbles. Right? So if you look at this dividend distribution, so I think it's exactly the same as the dividend distribution of our experiment. Right? So you have equal probability of receiving 0 or 8 or 28 or 60 as your dividend at the end of each trading period. Right? The first experiment on asset bubbles actually had a longer duration. It has 15 periods of trading. Right? So as we can see from or infer or calculate from this dividend distribution, the expected dividend payment is 24, right? In the original experiment in 1988 is 24 US cents. Right? Back then it's a lot of money already. Right? So in our experiment, it's 24 experimental currency as francs. Because we know the expected value of dividend, we can actually easily calculate the fundamental value of each share of the asset, right? Because the asset is worth nothing at the end of the experiment. The only value that you can get from the asset is the dividend, the cash flow that you can receive, right? In each period, it will pay you 24 cents, right? And here in this experiment, because there are 15 trading periods, each period on average will pay you 24 cents. So the fundamental value at the start of the trading period is 360, and it keeps decreasing, right? For each period, the fundamental value decreased by 24 cents. Right? So these are the fundamental value. Right? And then if you look at the trading price, we can clearly see whether a bubble occurs. Right? So here is a typical evolution of the prices in this asset market. In a lot of those markets, the trading price starts below the fundamental value. It's likely due to maybe risk aversion or you are not familiar with this market yet. Right? So you're just trying to get warming up. And then gradually we see a great deviation of the price from fundamental value. And towards the end, because towards the end, everyone knows the asset would worth nothing. So they realize towards the end value should be 0. So that's why right before the end of the experiment, we saw this crash, right? So height of this line represent the trading price, and also the numbers near each dot represent the trading volume, how many transactions occurs. Right? So the price shown here are the median trading price of all the transactions. Right? So as we can see here, a typical asset market, even though the fundamental value can be clearly calculated and everyone know the expected value, we still observe price bubble and then the crash of the asset market. And one interesting twist here, in this trading market, there are 6 to 12 participants in each market trading with each other, right? So with a small number of participants. And here, an interesting study increased the size of the market, right, to make it more realistic. We know that in the real asset or stock market, we have maybe thousands, if not millions of traders. They're trading with each other, right? So as we can see from this experiment with 304, more than 300 traders, which is significantly larger than the original first asset experimental market, we see a much greater bubbles, right? And here, this dot line represent the expected value of the dividend, or these represent the fundamental value. And on the top line represent the maximum fundamental value, right? Because the dividend payment is random, we assume in each period that you are very lucky. In each period, you receive the maximum possible dividend. So then the value of the stock of the asset will be like here. As you can see here, the trading price is even significantly higher than the maximum possible fundamental value, right? So that is more dramatic. So we can expect that when we have a larger crowd, asset price will become more obvious and more serious. And also, the next experiment demonstrating that when we have overlapping generations that mixed with experienced traders and new traders, asset bubble can still emerge. So here is the experiment that in this whole trading horizon, there are 3 generations. Each generation just trade for 10 periods, and they have 5 periods overlap with each other. As we can see here, in generation 1, towards the end, they experience the bubble and crash, but experiencing the crash does not help eliminating future crash or future price bubbles, right? So as we can see here, the price bubble form when new generation enter with additional liquidity and bursting as old generation exit with cash, right? So here, when generation 2 get into the market because they have more cash, that significantly drives up the price. But when generation 1 start to exit with their money, right? So liquidity, the cash is lower, that causes the bust, the crash of the market. And an interesting observation is that the bubble can reoccur after previous generation experience a crash, right? So the previous experience does not help or with eliminating crash. Like generation 2, here generation 2 actually traded for 15 periods, longer than the other 2 generations. For generation 2, even though they have experienced the bubbles, they are still not able to eliminate the bubble. So this bubble can reoccur with overlapping generation, even if previous generation have already experienced a crash. This may be an example of difficulty to learn from description, right? So you heard that the previous generation describing the Great Depression, the crash of the stock market, but if you have not experienced it, it's difficult for you to sense, to real feel that there may be some black swan or some bubbles would occur. And now we are ready to look at your performance, right? So in our experiment, we have more than 40 participants, and that give us 7 trading groups, right? So each group has 6 to 7 trading partners, right? So each market with 6 to 7 traders. And as we can see here, with the exception of one market, which is group 7, right? So it just has slight overpricing in the period 2. These shows are the median trading price, right? So in the other 6 market, we observe greater deviation of the trading price from the fundamental value. And this solid line represent the average of this trading price of the 7 market, right? So we observe this general pattern, at least for the first half of the experiment, the general pattern of bubble emergence and then likely to be crash, right? So because eventually the fundamental value becomes 0, so it should go back to 0. You see, it's very common to observe asset bubbles in experimental market, even though the fundamental value can be precisely calculated. Right? Now, so these are some experiments demonstrating the existence of asset bubbles. One criticism towards those market is that in all this market, we have an asset with decreasing or declining fundamental value. Some people criticize this experiment, saying that in real asset market, assets with declining fundamental value are very rare. So now the question is, can we still observe bubbles if we have this non-declining fundamental value? Sometimes it's a flat fundamental value or increasing fundamental value. Right? How can we implement this? It turns out to be quite easy to implement this. Right? So asset, for example, let's consider an asset with expected dividend D per period, and interest rate for cash is R. Assuming the expected dividend is D constant, interest rate for cash R constant, and we know from the previous formula of calculating the value of stock, the present value of the stock, assuming the payment is forever, for infinite horizon, then the asset value is D over R, right? So it's constant fundamental value. But the issue with this infinite horizon asset is that we cannot run the experiment for infinite number of rounds, right? So we were not even able to finish 10 rounds, 10 trading periods, right? We only finished 5 trading periods. So how can we solve this problem that we have to run the experiment with finite horizon? That's the question. It turns out to be also quite easy and straightforward to implement this. We can just have a final period redemption value that is equal to D over R, right? Recall that this asset with the expected dividend D and the interest rate R is present value at any period is D over R, right? Suppose towards the end, as the end of the trading period, at the end of the experiment, we have this final redemption value of D over R, meaning that if you still hold the asset, you will get paid D over R. Then this fundamental value will be kept constant, right? And from this design, you can also have increasing and also decreasing. Decreasing is not interesting because we have already seen decreasing fundamental value market, right? So we can also have increasing fundamental value asset. Just increase the final period redemption value. Suppose the final period redemption value is 3 times D over R, then the fundamental value will actually be increasing, right? So the first trading period is close to D over R, and gradually it increases to 3D over R. Right? So that's how you implement a flat fundamental value asset. As it turned out, if we have assets that has this flat fundamental value, we still observe asset bubbles, right? So here is one experiment. And there are 2 types of market, right? But we see in all types of market, we observe bubbles. And one interesting observation here is that this excess cash is one important factor to determine whether asset bubbles can occur and how large the bubbles would be observed. Right? So here, this 2 type of treatment just vary the amount of cash you can hold, right? While holding the fundamental value the same. So for the high wealth market, the expected dividend payment is $1.4, but the corresponding interest rate is 20%. So meaning that if initially you have the same amount of cash, because you have 20% of interest paid to you, each time period, the cash is increased by 20%. So that's considering exponential growth, you will have a lot of cash in the middle and towards the end of the experiment. In comparison, if you have dividend 0.7 and interest rate is only 10%, the amount of cash is significantly lower. And as we observe by comparing these 2 treatments, one with a lot of cash, the other with fewer cash, you will see more significant, more dramatic bubbles observed, right? So again, even with flat fundamental value. Here is another experiment that demonstrating the effect of excess cash, right? So it has two treatment also, but the major difference of this market from the previous one is that you can borrow cash to trade in the asset market, right? And the two treatment is the down payment that you need to have in order to borrow cash. If you have high down payment, then you have to have some collateral in deposit to higher collateral money that reserve you cannot touch it to borrow money. In that case, you have fewer amount of cash, and for low down payment treatment, you have more cash. And we again observe that when cash is more readily available, we will be able to observe a larger bubble in the corresponding asset market, right? So summarizing these two experiments of flat fundamental value asset, we can be confidently claim that asset market can experience bubbles even with flat fundamental value. Now let's summarize the asset market experiment. So here are some general observations. When we look at the tradings and the corresponding price in asset market, we usually observe price in period 1 is below the fundamental value. Not necessarily the case, but it's likely to be slightly below. But then it quickly rises high above this point, about this fundamental value, but eventually it would crash. And price bubbles are enhanced with excess cash, right? So if you have a lot of cash, you can borrow, for example, or you can earn a lot of dividend, a lot of interest from your cash, then price bubble will become more serious. Right? And here I put testosterone. Right? So here it is a conclusion from an interesting asset market experiment that the students, the participant, before start trading, they get some testosterone, right? So wiped in their forearm so that this testosterone would get absorbed into their body, right? And it has been observed that when you get more testosterone, the male hormone, that would actually increase asset bubble. Right? And also, it has been observed that if you eliminate the possibility of speculation, meaning that the buyers, when they have cash, they can only buy, they cannot resell later. And the sellers, they can only sell their shares, but they cannot buy back. They cannot buy any of the shares. Right? So this would eliminate the possibility of speculation, meaning that you can buy at high price in the hope that you can sell it at higher price. But this elimination does not prevent bubbles, right? So it shows us that speculation is not the only reason that caused the corresponding bubble. People may just expect the price will rise in the future, right? And also, bubble aptitudes are reduced by prior trading experience in the same asset market. If I ask you to play this asset market for 10 periods, we will observe bubbles. And then we ask you to play this again, we will see a smaller bubble, right? It does not completely eliminate it, but we still observe this, right? And also, interestingly, if we recruit some professional traders into the asset market, bubbles still occur. So this demonstrates that trading experience does not eliminate, right? So it helps a bit, but it does not eliminate. And if we have delayed dividend payment, short sales, and the availability of other activity, for example, if in our experiment, you can trade and buy or sell the asset shares, at the same time, you can trade in a market that you can buy a certain good, right? Apple, for example, then the bubble size will be reduced. It seems that one reason that bubbles can occur is because you do not have any other activities to do. Right? So if you do not have any other activities and you can only trade in the asset market, that will generate a bigger bubble. Right? So one lesson we could learn from this is that if you're constantly looking at the evolution of the market price, you are more likely to trade, and that behavior can more easily to lead to bubbles. One last observation is that when we run regressions to see what are the characteristics that can predict earning, it shows that high CRT score which we have discussed what it means. High CRT score meaning that you can refrain from your system one thinking and more likely to engage your system two thinking. This would correlate with high earnings, meaning that people who this implies that people who are likely to engage their system two thinkings can maybe refrain from this unprofitable trading that could increase their earnings. Now, to provide some insight into this bubble formation, this experiment by Holt et al., published in 2017, tried to elicit people's expectation of future prices, their prediction of future prices. Right? So basically, before this trading period, each participant were asked to predict the trading price of this following period, this current period, and the next period, and 2 periods ahead. Right? So these are incentivized. If your predictions are close to the actual trading price, then you get some additional payment. Right? And in this corresponding figure, it shows the evolution of the price, the solid line, and the gray lines represent the prediction for this period and the next 2 periods, right? And for this 2 market, of course, we see bubbles formed, right? And it's interesting to compare the prediction of the market price with the actual trading price. We see that short-term forecasts tend to be too slow and too flat during the boom phase before reaching the peak. If you look at this 2 market as an example, before reaching the peak, the predictions is more flat than the actual evolution, right? And after reaching the peak, you see that the prediction is just too high and also too flat during the bust phase, right? So they predict that the market is likely to rise when it's at the peak, and when it's crash, they can anticipate the decrease in the stock price, but they underestimate how fast the crash could occur. So this is telling us that the downturn at the peak price is not generally anticipated. So again, if you think about this greater fool theory, you just try to have this timing, the market would crash, but you just try to act one step ahead of other traders. It's difficult to get the right timing because in the experiment like this, no one actually generally expect or anticipate the corresponding crash and when it would occur. Now, here is a quite interesting quote by Christine Lagarde, who's the president of the European Central Bank. This comment was after this 2008 financial crisis. She actually commented that if Lehman Brothers had been Lehman Sisters, the results would have been very different. So what she means is that males are generally too competitive, too aggressive, sometimes too greedy. That is probably one fundamental reason generate this 2008 financial crisis. Is it true? Again, we can test this in the lab. In the field, in the real stock market, it's not easy to do that, but in the lab, we can actually do that, right? So here is an experiment conducted to test gender differences, right? So look at the result. On the left is the mixed gender market, is just replicating the previous experimental result, right? On the right, we see we have male-only trading group and female-only trading group. And by comparison, we can sense the gender difference in trading. So here, the line on the top represent the medium trading price of all male trading market. And the circle one, the bottom line represent the trading price of all female trading market. As we can see here, when we have all female trading market, bubbles are much smaller. This seems to confirm what is being believed. Lehman Sisters might perform better in terms of not getting too much trouble in generating bubbles. That's the reading from this study alone, right? But if you look at other studies, gender differences are actually quite complicated. It cannot be summarized as males are definitely worse in terms of generating bubbles, right? So here are 6 studies, actually 5 studies that tested the corresponding gender differences. And it seems that whether gender differences are observed, it depends on the context and the setting, right? Universally, we observe that if there are gender differences, females perform better in terms of generating smaller bubbles. But in a lot of situations, there's no difference, right? So here, the 2015 Echoes Feng Bun is the study that we see in the previous slide, identify the gender difference. And in Wang et al., this paper published 2 years later also identified male has higher bubbles, right? The gender difference. But these results is for American participant. For the experiment conducted in China, gender difference was not observed. And then for Holt et al., this male also generated larger and higher price levels. And this Echo and Feng Bun found no difference, right? But in the same study of Holt et al., with flat fundamental value, there's no gender difference, right? So it seems the gender difference would depend a lot on the context, on the setting. Now, the last topic I want to discuss that try to provide some insight of why bubbles occur is try to distinguish different trading strategies or different type of traders in the market. Can we identify different type of traders in the market so that we can better understand what is going on? Right? So in a famous paper in finance, DeLong et al. Published in 1990, they categorize theoretically 3 different types of traders. And the first type is passive traders. This type of trader, also called value trader, like Warren Buffett, they buy when prices are below fundamental value and they sell when it's above fundamental value. So this type of trader would expect reversion to intrinsic value. Right? So they would have this rational arbitrage. So this type of market, if everyone is passive trader in the market, then we would not expect bubbles, right? So because this type of traders would stabilize the market. If you're trading too high, they will be rationalized. They will buy, but they will sell. So that would reduce the price. So it would stabilize the market. The second type of traders is the so-called feedback traders, trend followers. They may be the most common traders that we observe. If you look at the price, it rose yesterday, and you expect that the price will rise again in the future, right? So increased demand would observe among these type of traders when prices are rising because they would expect the trend of the market price would repeat. Right? In other words, they extrapolate recent trend, and because of their behavior, they usually amplify price deviation and bubble growth. Right? So these type of traders are probably the main reason we observe bubbles. And the last type of trader is called speculative traders. They buy if prices are expected to continue rising, regardless of fundamentals. They are probably the believers of the greater fool theory. Right? So they expect to resell at higher price before crash, and they actually sustain bubbles. Right? So in their original theory, DeLong actually their main claim is that speculative traders, as believed by most people back then, could stabilize the market. But in their theoretical model, no. Sometimes the speculative traders, when they believe that a lot of people are feedback traders, they can actually sustain bubbles and exaggerate the bubbles. They try to exploit feedback traders because they expect the greater fool can purchase their price. They make bubbles worse. Right? So that's their original claim in their paper. Right? But the main thing that we borrow from their paper is these 3 types of traders. And then we can actually try to estimate the proportion of different type of traders in experimental asset market. So here are the 3 types of traders. We have feedback traders who are likely to generate bubbles. We have passive traders who are likely to stabilize the market. And then we have speculative traders. You can say they best respond to the composition of other traders. Right? So they try to exploit, for example, the feedback traders. They know feedback trader would follow the trend. They try to exploit that. They are willing to buy the corresponding asset at a price higher than the fundamental value if they believe that they can sell it at an even higher value. Right now, the estimated proportion from the paper Haruvi and Noether, feedback traders 36%, consistent with a lot of people's expectation, is account for the majority, right? So it's not the majority, but it's account for the largest percentage of the traders. And speculative traders, like George Soros, account for 33%. And the smallest portion is the value traders or passive traders. Warren Buffett, as in real life, is just a small number, minority. It's account for 1/4 of all the traders, right? And that's give us a sense because feedback traders account for a large proportion of the traders, they are likely to generate the corresponding bubbles because whenever they see the asset increasing in price, they are likely to purchase because they expect it will rise in the future. And speculative traders, they try to exploit this trend. They will follow the trend. Both these two types actually exacerbate the size of the bubble. Now, that's the end of our discussion. So to summarize, we introduced how the value of asset should be determined, how the fundamental value should be determined, right? So the fundamental value of an asset derives from its expected future cash flow. And asset bubbles occur when prices greatly exceed fundamental values. So that's the definition of the asset bubbles. And investors may knowingly buy overvalued assets, expecting to sell later at a higher price to a greater fall. That's one important theory, and it's actually supported by the experimental result. Right? People just are willing to buy at overprice, expect that they can sell at an even higher price. So experimental asset markets help us understand the mechanism that generated bubbles, and the bubbles can emerge even when fundamental values are clear and well known. So that's the major conclusion we can draw from experimental asset market. Right?